Hello and welcome. My name is Wakamiro. I comment on matters finance, investment, the economy, and everything in between to help individuals make better economic decisions. So for a while, I've been commenting on this pet topic or pet subject of mine, that is investing in government securities, treasury bills, and treasury bonds. And at this moment, I feel it will be important to go back to some basics so that my followers might be able to appreciate where we are coming from in terms of investments and be able to understand the basics so that at least one knows what they are getting into in terms of investment, knowing the basics. This would be very helpful. So today I want to talk about the capital markets and talk about money markets and be able to differentiate between the two, between the money market and the capital markets. So when we'll start with the capital markets, and I will not take the classroom direction of defining. Uh, Now this would demand someone starting to clam maybe these definitions. I will take the approach of explaining what it is so that one might be able to understand it and they can internalize it. So when we talk about the capital markets, um, you hear market, it is a market. And where a market, we talk about a market, they are there are tradable goods in that market, and there are also participants in that market. So now when we talk about the capital markets, this is where institutions or government companies will come in to raise funds for long-term investments. And now again, they are investors who are willing to lead or take ownings of these part or ownings of these institutions in return to what they are giving out, that is the money they are giving out. So basically, now when you come to the capital markets, this is where you'll find shares or bonds. And what is happening, we talk about equity or debt. So if it is a bond being issued, now we'll talk about a debt investor. If it is equity, shareholding shares or stocks, we will talk about an equity investor. So the structure of that market is where we have the issuing entity and now the investor. And this would be a primary market, a primary capital market. So maybe I would have to talk about what a bond is and what an equity is, what a share is, and what one gets in return. So if an institution, a government or a company is issuing debt, who is willing to take debt, debt investment from investors, so what the investor will get in return is what we call a bond. So in early days, if you did lend money to a government or a company, what they would issue you with is a paper bond certificate. Though that is not happening today, now that we are in a digital era. All what happens is transfer on electronic ledgers. So this is where a CDS account comes in. I'll talk about it in coming sessions, but a CDS, take it as an electronic safe box. So if you have, if you have invested, you are a debt investor investing in a company or a government, and what we call a bond, what will happen is a transfer to signify that you are the owner or you have led money to that institutions, and now they are the terms, conditions, the rates, and everything will be shown there. Then for uh, an equity investor, what you get from now a company that you have invested in is a portion of that company. So the company will be divided into what we call units of ownership or shares. So if you take 1,000, will be said to be owning 1,000 units of that company. So also, again, we are not doing paper certificates as in early days. We are doing electronic certificates, which are also transferred through these electronic ledgers. You also have a CDS account for that purpose, for when you have purchased the ESA transfer. So as I had said earlier, when the trade is between maybe the company offering the shares and the investor, or the institution such as a government and the investor, this would be defined as the primary market. Where we go to the market, these securities are tradable. We can go to another market where me, an equity investor in company A, I transfer my ownership to you in exchange of money at an agreed price. Now these are all, I took a bond from the government or a company that had issued some bonds and transfer these to another investor. Now this will be termed as a secondary market. So a takeaway there is that at the capital markets, we are raising, all these institutions or companies, the government are raising funds for long-term investment projects. And we can have a primary market or a secondary market where these securities will be exchanged. And we have said that the securities that we are talking about here, we can talk about shares or what people call stocks or bonds. So these are the instruments being traded in that market. Moving on. Let's talk about the money market. So I've said in the capital markets, we are looking at in the long term, like funds, the institutions that are raising these funds are in the long term. Like if you are doing shares of a company, it is for a lifetime of that company until dissolution of that company, unless you trade the shares. The ownership is it's to the end of this company or its dissolution. If you are taking bond, you'll find a company doing bonds for 5 years. You take an example of the recent bond by EABL or East African Breweries. It was a 5-year bond. You will get a government doing 10-year bond or 25-year bond. So whatever is in the capital markets is in the long term. In contrast, now in the money markets, what we find there is where it is an intermediary market, and the instruments that are traded there, they are short term. And this short term, it can vary between hours to 1 year max. So the instruments that are traded in that money market will tend to fall within that. You will find instruments for 30 days, or for 60 days, 90 days, 180 days, or around 362 days. So the institution participating in these money markets, you'll find deposit house, you'll find banks, you'll find government through treasury bills. You'll find companies that, for example, you'll find a company looking, offering a commercial paper. So these instruments will tend not to take long, and like now in the capital markets, in the money markets, we are talking about short term. So the institutions that are trading among themselves, or them and investors, they are looking for funds for short term. I've mentioned about a commercial paper or a commercial note. What happens is the company is looking to fund its short-term liabilities, maybe pay suppliers or sort its working capital in the short term, nothing exceeding 1 year. So they'll issue a commercial paper to someone willing to lend them money for a period max 1 year, and it can be less. And then at an agreed terms and rates, I've mentioned about the government treasury bills, which will come in 3 months, 6 months, and in 12 months. So basically, now that is what can be defined as money markets, and it's differentiating to differentiate it from the capital markets. take